Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
All right. Hope everybody had a healthy, safe weekend. As we approach end of April this week, we will dip our toes into May. As, despite the pandemic, time continues to march forward. Time to start rethinking about tax time, which is now July 15th. So we're going to get started this morning. Talk about the markets. Talk about some things to think about, not just this week, but over the long term, and then turn things over to Brad. We're going to get started this morning. I talked a couple of weeks ago about a book, The Subtle Art of Not Caring, let's call it, not giving a thing. This is a book that was written a couple of years ago, and I think there's a couple of other points I wanted to make with respect to some thoughts from the book, and wanted to share those thoughts with you this morning. One of the things that many of us do in our lives, we may even do it when we're with people we care about in the workplace. Advisors may do it with clients. Clients may do it with their clients. And that is the unconscious, oftentimes, desire to always be right. And that is something that can lead to more problems than successes. And the irony is, as Dale Carnegie put it in How to Win Friends and Influence People, is you can't win an argument. You can't, because if you lose it, you lose it. And if you win it, you lose it. Well, why is that? Suppose you triumph over someone else and shoot their argument full of holes and prove to her that her argument does not have merit, or prove to him that his argument doesn't have merit. Then what? Well, you will feel good. You might feel fine. But what about the person that you were speaking with? You will have made him or her feel inferior. You will have hurt their pride, and you will probably have set up some resentment as a result of your triumph. If you focus always on being right, then you'll have a fixed mindset. You'll stop learning because what you learn may contradict what you know. You won't grow, and most importantly, perhaps, is you're not going to have too many friends. Another construct to think about, something that many of us view as a positive and view as something that we should always do, and that's to always stay positive and to always avoid pain. And in this book, the author takes the position that completely getting rid of pain and always staying positive, while it's something that you may want to skew towards, is not something that you can realistically achieve, and the closer you get to achieving it, perhaps can lead to more problems than successes. First off, completely getting rid of negative instigators and negative emotions is simply impossible. It's reality. It's the facts of the way people are constructed in nature, is that people you love and other people you're in contact with will disappoint you. They will say things you don't like, or say something in a tone you don't care for. Unless you decide to spend your life in a Buddhist monastery with people who have taken vows of silence, negativity will always be a part of our lives that we cannot control, but we can control how we deal with it. The trick with negative emotions is to express them in a socially acceptable and healthy manner, and to express them in a way that aligns with our values. And there is another reason we don't always want to stay positive, and that is because experiencing some pain, which comes from not always being positive, is something that does lead to positive outcomes. If you think about it, some of the greatest moments of one's life are not pleasant, not successful, not known, and not positive. Things that are worthy usually come with some amount of pain, like perhaps having children, perhaps running a marathon, dating, as we all know fairly well, investing. For those who exercise, working out, that maxim, no pain, no gain, really does have some strong correlation to reality. So what do we need to do in order to sometimes experience negativity, to try and stay as positive as possible, to not try and win every argument that we come across. And how do we achieve that? Well, one of the good bedrock foundations to be able to achieve many of those objectives is to have good values. And what are good values? Good values are, number one, reality-based, number two, socially constructive, and number three, immediate and controllable. If you reverse these, you'll get bad values. And if you think about good values are born inside of you. They are achieved internally. Bad values are things that are imposed on you from the outside world. One of the complications, perhaps, from the 24/7 society that we are in, from social media, from constant videos, and from videos that you watch reinforcing what you watch going forward. So, for example, if you're a Netflix user or a YouTube user, it's more than likely that based on your previous viewing history, you're going to get recommendations, and you may enjoy those recommendations. You may get the same from Amazon with books, and that has a lot of positives. But one of the negatives that comes from that is that very often you will enjoy those books because those books are in alignment with what you've previously read and that you think is things that have made sense, or YouTube videos that you've watched that you think are in alignment with your values, and you're constantly getting that reinforcement of hearing the same thing, the same message repetitively. But the downside to that is that you may start forming values that are external, not values that are internal. I'm going to move on to another topic. And this is from an article that was in this week's Barron's, and I'm going to talk about where we are this morning. But article in this week's Barron's was an interview with a famous poker player. She's a woman who won more than $4 million in a poker tournament recently, and they were interviewing her with respect to the financial markets. And she was talking about making decisions, and I thought that this was something that was pertinent, number one, in everyone's life on a day-to-day basis with whatever they're doing, and number two, it's especially pertinent with the financial markets and investing, whether you're an investor or an advisor that is giving advice on how to invest. And if you're a poker player, one of the things that you're doing consistently is you're making decisions, and you're making decisions in times or periods of great uncertainty, and you're making them very quickly, which is not very different from what investors are doing in the financial markets. Most decisions are made under uncertainty, and she goes on to say they're heavily influenced by luck and by hidden information, and we fool ourselves into thinking that it's not so uncertain. When making a decision, we're always balancing time and certainty. So, in a perfect world, if our lives were infinite and we had an infinite time to make decisions, we would probably make decisions over a lot longer period of time so that we could get them right. But that is something that is a luxury that we do not have, so we need to make decisions relatively quickly. And there are three types of decisions that she says that we have to make. First is decisions that the outcome really doesn't matter all that much and is not life-changing, and we can make them in general relatively quickly. Perhaps the decision you make when you're in the old days sitting in a restaurant and having to choose what to order for dinner. That type of decision is something that you can make relatively quickly. Second, when the outcome matters to you, you need to think about optionality. So, for example, if you're thinking about moving from your home and taking a new job, that's a big decision, and you start thinking about, well, what if I didn't do this? What if I, perhaps thinking about the options, if I move, I'm actually moving from Florida to New Jersey, and I got to factor the weather in. You need to take other options into account, and those decisions typically take a little longer. And finally, the third piece is decisions when time can influence the outcome. So perhaps you're having to make a decision, and in your mind, the longer you wait to make that decision, the worse the outcome gets no matter what. That's a decision you need to make relatively quickly. Or perhaps what procrastinators will often do, and sometimes they may be right, sometimes they may not, is they'll make a decision and delay it because in their mind, by waiting, they're getting more information, and they think that the information that they're getting will help them make a better decision, and time is not so crucial. Time will always tell. Finally, I thought that the lady in this article and her thoughts on what she did during the stock market meltdown recently was interesting. When asked, what did you do with your money during the crisis, she responded, nothing on purpose. I was 65% equities, 35% bonds going into the crisis. My investment professional called and asked, do you want to talk about it? I said no. And when asked why she said no, she said, I was protecting myself against my own irrationality. And what she was saying is that she was afraid of what she calls the Dunning-Kruger Effect, which is a cognitive bias in which people with low ability at a task overestimate their ability. In other words, her ability to make an intelligent decision on whether or not she should buy or sell. She was consciously aware that she did not have the knowledge to make that decision and intentionally chose to do nothing. So recognize in advance the places where you may not make a rational decision. People who in 2010 and 2019 who just left their money in the market would have done better than all the people who decided they would sell at the high and buy the dip. And if you're a financial professional, you've probably spoken to some of those people who thought they could do that, and as we know, it is a very difficult thing to do. You've got to be right twice. All right, so taking a look at this morning, let's back up to where we were last week. Last week we did see some volatility day to day, but ultimately we wound up down for the week. In the U.S., we were down 1.3% on the S&P, about 2% on the Dow, and only 0.2% on the NASDAQ. International markets, emerging markets, were down about 2% last week. The Treasury bond, the 10-year Treasury, was up slightly last week. And in the municipal market, and Brad could talk more in depth about munis and the lack of general commonality amongst bonds in the municipal market. But on average, and average is a dangerous word here, municipals were down about 1% last week, bringing municipals into negative territory, about 1.1% for the year. This morning, we are seeing futures to the upside. Futures have extended the rally that we saw last week, and right now we're seeing S&P futures up a little over 30 points, Dow futures up about 230 points, NASDAQ futures up over 100 points, Russell futures, which has been the lagging index, the small cap stocks, more sensitive to the coronavirus, up about 23 points this morning. That's after several states, including Georgia, Alaska, and Oklahoma, have already begun reopening, while New York Governor Cuomo yesterday said a phased reopening will likely begin with construction and manufacturing jobs in upstate New York on May 15th. Markets taking some solace and comfort in those remarks from the New York governor, who's been amongst the most cautious about possibly beginning the process of reopening the New York economy, saying that New York has clearly passed the peak. And he is optimistic about getting back to business. Overseas, the UK, Italy, and South Korea also talked about reopening plans. Also helping the markets this morning was central bank news. The Bank of Japan left its interest rate on excess reserves unchanged, but increased its purchases of corporate bonds and commercial paper. Later in the week, the Federal Reserve and the European Central Bank will announce their decisions on monetary policy on Wednesday and Thursday, respectively. Not all stocks are poised to open higher this morning. Energy stocks struggling in pre-market action. Pullback right now of 24% this morning in West Texas Intermediate. The June contract is trading down $4 a barrel to $12.89 a barrel this morning. Interestingly, natural gas also down significantly this morning. Natural gas had not participated in the downdraft that we had seen previously in oil, but natural gas this morning down about 14 cents or about 8% this morning. Dollar slightly weaker this morning, and Treasury yields moving a little bit higher, but again, all within the similar range that they've been trading in before. The 2 years at about 23 basis points, the 30 years at about 120, the 10 years at 63 basis points, the 3 months is at about 12 basis points. In news, the World Health Organization says there is currently no evidence that people who have recovered from COVID-19 and have antibodies are protected from a second wave of infection. Some companies this morning, Deutsche Bank beat on profits, warned on their capital buffers. Checkpoint Software said that their profit topped estimates on higher demand for remote access networks. Neiman Marcus, who had declared bankruptcy, is in the midst of a struggle of egos here, as an investor group is opposed to plans of a financing package and wants the company to be sold off in bankruptcy. The airlines in the news this morning. Treasury Department said on Saturday to release an additional $9.5 billion from the payroll support program to U.S. carriers to help them in the pandemic. Diamond Offshore, symbol DO, filed for bankruptcy protection in Texas on Sunday. That was after the company recently skipped an interest payment and had retained restructuring advisors. So another casualty in the energy space. Lot to look forward to this week. Lots of earnings. Tomorrow, Ford Motor, Merck, Pepsi, Pfizer, Starbucks, UPS reporting earnings. Also tomorrow we get consumer confidence for April. That's expected to drop significantly to 80 from 120 in March. Then on Wednesday we get the initial estimate of GDP for the first quarter. Economists expect a contraction of 4%, but that number is literally all over the board, so that's going to be very carefully watched. Wednesday, we also get earnings from Facebook, General Electric, MasterCard, Microsoft, Tesla. Also, the Federal Open Market Committee announces its monetary policy decision on Wednesday. Thursday, we get earnings from Amazon, Apple, Comcast, ConocoPhillips, Gilead, Kraft Heinz, McDonald's, Twitter, and Visa. We also get personal income and spending for March. Thursday, the earnings parade continues, and just to name a few, AbbVie, Chevron, Exxon, Honeywell, all holding conference calls. Also on Friday, we get the Institute for Supply Management releasing its manufacturing purchases index for April. Expectations there are for a reading of 36.1. Even though Friday is the first day of April, because it's the first day of the month, we do not get the unemployment report, which will also be carefully watched. That'll come out the following Friday. Moving on to Barron's. Barron's had their big money poll, which is interesting given the all that we've been experiencing in the financial markets, to get an insight into what money managers are thinking. No surprise that big money managers are anxious about the near term, but see better days in 2021. What's their market sentiment? 20% think the market's overvalued, 52% undervalued. That leaves 28% at fairly valued. For financial professionals, describe their outlook for U.S. equities. 39% are bullish this year, 20% bearish, the rest neutral. And for next year, 2021, financial professionals, 83% bullish, 4% bearish for 2021. If you're bullish, where do you see the market at the end of 2020? They're looking at 24,658, so not dramatically different than where we are now. Those are the bulls. The bears seeing the market somewhere in the neighborhood of 20,000. The bulls, though, are seeing a big uptick in terms of where the market is in June of 21. 6 months after the end of the year, they're looking for the Dow at around 27,200. Bears still expect the market to stay at around 20,000. Are your clients bullish, bearish, or neutral? Most advisors, interestingly, say their clients are bearish. 54% of them are bearish versus 21% bullish, so they're saying that they are significantly more bullish than their clients. 67% of these big money managers have said that they have been buyers of stocks in the last month. 33% have been sellers. How are their portfolios currently constructed? They say 60% equities, 22% fixed income, 13% cash, 5% alternatives. Within that fixed income sleeve, the biggest component is municipal bonds, which represent about 8% of their allocation. When asked what will be the best performing equity market over the next 12 months, interestingly, 62% said U.S. equities. Number 2 is emerging markets at 16%. China was 14%, and interestingly, Europe was 5% in that poll. In terms of politics, who's going to win the next election? Big money managers overwhelmingly say Donald Trump, 56%, 39% say Joe Biden. The other 5% say someone else, I'm not sure who. Most of the managers expect the Republicans to retain the Senate, 89%, 75% expect the Democrats to retain the House. Barron's also had a poll where they asked individual investors. This is Barron's going directly to individual investors and asking them if they're bullish or bearish. And in that poll, 55% of individual investors right now are bearish, only 15% are bullish, and going forward for next year, 54% of individual investors are bullish and 12% are bearish. So, moving on to a couple of different theses and stories in Barron's. One of the topics that Barron's talked about was inflation, and that could obviously have a significant impact on the pricing of debt or bonds. And Barron's wrote an article entitled, "Today's Stimulus Spending Will Lead to Tomorrow's Inflation." And what the thesis of this article is that different than in 2008, 2009, when the Fed did some significant quantitative easing, the end result of it here was that at the end of the day, the money supply didn't increase all that much because the velocity of money slowed down. What the authors of this article are concerned about is this time we are having a much larger quantitative easing. At the same time, the size of the fiscal policy is significantly larger than 2008 and 2009. So while in the near term the concerns remain unemployment and deflation, looking out further in maybe 2021 or 2022, the concern is that inflation could jump, and this is because of this rising money supply with government spending in excess of revenues at a time when the economy is recovering. Could start to see meaningful inflation. If that's the case, what do you want to start thinking about in terms of investments? If you start seeing meaningful inflation in a year or two from now, you might want to start thinking about investments in real estate, like real estate investment trusts, small cap stocks, which have less currency exposure, and another sector that's gotten real beaten up, which is commodities and emerging markets. A couple of stocks to think about in this current world that we're in. Barron's talked about food stocks, which have been largely out of favor, and they say that they have a list here of 5 that they say are worth considering. Household names: Campbell's Soup, ConAgra, General Mills, Kellogg, and Kraft Heinz. Thesis here is that despite the fact that the crisis is ongoing, consumers are consistently buying groceries, as we know personally, and brand names are the product of choice. Part of that is because these large brands have been elbowing out private labels, which prior to this crisis, private labels sales had grown to about 25% of unit sales. But what's taken place now, in part because big food companies have the resources to help supermarket chains stock their shelves and to help facilitate home delivery, is brand names have been regaining share. And Barron suggests taking a look at these 5 different companies. They do point out that Kraft Heinz, ConAgra, and Campbell's Soup have higher debt levels than General Mills and Kellogg, and therefore there's a little bit more risk to their dividends, and that's why in many of those cases the dividend yields are a little higher for the companies with the larger debt loads. Barron's also talked about oil. Oil down again this morning, but Barron's did talk about some stocks to consider in the oil space if you have that desire. I know that I've spoken to several advisors and clients who are expressing or inquiring about how they could possibly take advantage of very low oil prices if they have a thesis that oil is going to climb in value. I'm not predicting the price of oil, but if that's your thesis, Barron's has a few stocks to consider directly in the oil space, which is Chevron, Texaco, CVX, ConocoPhillips, COP, Schlumberger, SLB, and Phillips 66, the refiner, PSX. Their thesis on Chevron is that they've got amongst the strongest balance sheets in the industry, and they pay a nice dividend of just under 6%. Phillips 66 owns pipelines and gas stations. Bank of America analyst Doug Legatt thinks it's a buy at current levels, given that it can nearly cover its capital expenditures and dividends within the current operating cash flow environment, has less debt relative to its peers. If you're thinking about ConocoPhillips, they also have a debt load that's about half as large as other producers, and they have significant operations outside the United States, away from West Texas Intermediate, where the biggest crash has taken place in the oil space. And Schlumberger, the analysts here are positive on the fact that they cut their dividend by 75%, and that frees up about $2 billion in cash flow, which should enable them to start deleveraging their balance sheet. Barron's also ran a separate article talking about 4 plays within the industrials that are companies that have exposure to oil but are not oil stocks. They mentioned Flowserve FLS, a leader in pumps, valves, and seals, about 40% of its sales from the energy-related customers. Stock's down about 50% and trades for about 13 times 2021 profits. Also mentioned Emerson Electric, EMR, about a third of its sales from energy, trading around 17 times 2020 estimates there. Now, if you thought before the crisis about companies that would be beneficiaries of the crisis, and this is one of the reasons why investing is so difficult and challenging, one of the groups that probably would have come to mind is food delivery, and companies like Grubhub would probably have come up on your list, along with names like Netflix and Zoom and Amazon. Yet what's happened during the pandemic is that food delivery stocks have not been stellar performers, despite the fact that Americans are ordering from home significantly more. Matter of fact, it's about 70% of a increase year over year. Yet these stocks have not participated like the stocks that are getting all the attention in the news, the aforementioned stocks that I just discussed. And Barron's is not suggesting that these stocks like Grubhub are a buy, or Uber through Uber Eats is a buy, but simply pointing out that the dynamics of this business are challenging, despite the fact that sales have gone up tremendously, and pointing to the fact that it's not always so easy to pick winners and losers. Finally, before I turn over to Brad, Barron's discussed one big insider buy at J.P. Morgan. Director there purchased $6.6 million of stock, or 75,000 shares last week, at an average price of 88, biggest open market purchase by an insider since February of 2016, when Jamie Dimon bought 500,000 shares for $26.6 million. That's everything I've got. Turn it over to Brad, talk some more about the markets. Good morning, Brad.
Good morning, Keith. Thank you. Good morning, everyone. Hope everyone had a good weekend. Before I start, I'm just going to take a deep breath because the normally sleepy municipal market has obviously not been sleeping as of late, and everybody is rightly asking a lot of questions about what's happening, where we're going, who's going to survive, who's not going to survive. So I'll just give you a couple of things that I've been thinking about over the weekend. For the 4th week in a row, municipals have been trading like equities. I've never seen anything like this. The ups and downs of this market are tremendous, and what I've gained from this over the last few weeks is that there is an opportunity for people who want to sell into strength. The strength usually happens on rumors, and the rumors are usually about the lesser credit bonds that you would want to consider selling anyway. When you're buying the dips, you would stay with the higher grade bonds, and as Keith and I were talking about earlier, for certain people there will be differences of what is considered high grade. There may be some opportunities. One of the things we're talking about is Port Authority, which is now negative watch by 2 services, but you have to figure that if there's a recovery, that the Port Authority running all the Northeast corridor between New York and New Jersey, the tunnels, the bridges, the airports, the General Revenue Port Authority bonds might be an interesting place to look. I spent the weekend reviewing a lot of portfolios, and I'm sure that a lot of advisors across the country were doing it to see what's been holding up and what hasn't. And there's no question that what was in financial trouble before the crisis is obviously in more trouble, and if anyone thinks that they're going to get out of trouble because there's going to be federal funding, that's not going to be the case. The writing is on the wall for what's going to get funding. I'm sure there will be some sort of federal funding, similar to the way the Fed said that they were going to help start to buy certain municipals of the largest states, cities, and counties, so they will help out, but they're certainly not going to give money to bail out anyone's pension problems. So see Puerto Rico for the original pension problem story, and see Illinois and a couple of others, which we'll talk about at a certain point. I'm also looking at insurance. I think that the insurance is okay as long as we don't have any major blowups. The insurance did hold up with Puerto Rico, as people who held Puerto Rico insured bonds saw, and we're back to the days of when I started in the business 30 years ago, when you wouldn't buy an insurer without questioning what the underlying credit was. So I do think that you should be looking at the underlying credit, see if it could stand alone. The insurance is what it is; it's a wrap. But if, as we saw during the financial crisis, the insurers could blow up as well. So I would say that we're not at the point of literally blood on the streets that create the panic. I would say that the lower grade municipal bonds are down 10 to 12%. Just to throw out an idea, you could talk about an MTA bond, a 4% long-term MTA bond that was trading around 105, and they're probably trading in the mid-high 90s now. So it's not too late to get out of certain things if you're really concerned, and the portfolio has too much of a weighting in any particular bond. You can replace the bond, sacrifice some yield, and get something that's more comfortable that you think might have a better shot at coming back. And I hate to use the MTA as an example. Maybe New Jersey Transportation Authority is a better example, or certainly Chicago or Illinois. The last thing that I'm going to say is it's very difficult to do, but you have to take emotion out of the equation. You can't always look at what you've made or what you lost. You have to look at where you think things are going. You have to be thoughtful when adding and subtracting from your portfolios. And the most important thing is that you sleep at night, because municipals, in my opinion, are there to preserve money. There will be opportunities to make money. I'd like that to be on the upswing. I'd like that to be on upward rating guidance and some sort of solution to the problem that we're in. But at the moment, I just want to make sure that everybody is sleeping at night and comfortable with what they have. And have a good week. Thanks.
Thanks, Brad. We'll say, as I was speaking this morning, General Motors announced that they're suspending their dividend and share buyback program. Also saw the headline that Nancy Pelosi said that the next virus relief bill will have state aid. That obviously will require Senate approval, and McConnell, as many of you know, has said that he was not in favor of that. So we'll see how that plays out in Congress. The president has expressed that he is in favor of providing aid to the states.
And Keith,
any
just
questions?
one comment along.
Yeah, go ahead,
Keith, one comment along those lines.
Yeah,
I'm certain there will be state aid. There's no question. It would be irresponsible if the government did not give state aid. However, they are not going to go deep, and they're not going to bail out pensions. So communities that had pension issues before are still going to have pension issues.
No, I agree with that thinking, and as Brad and I have discussed, if you were in trouble before the crisis, you're in general in more trouble after the crisis, regardless of the help that you're going to get. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.